patterns versus indicators. Which work better for you?
Well, I think I would look at chart patterns in the first instance. Draw on some Fibonacci retracements, for instance, which I rather like. Other things like Andrew's pitchfork is another sort of like nice drawing tool. And sort of try and put some trend lines on if trends exist, or some trying to identify areas of support and resistance. Starting with a chart, sort of maybe looking sort of a long time out, and then sort of zoning in and getting into a shorter time frame chart. And then once I've done that, I would sort of want to add on some indicators as well. So I would want to see, for instance, what the MACD looked like, or the RSI. I mean, if the RSI is sort of showing that something is overbought, then okay, that's another support for selling it. If the RSI is falling, or if the RSI is sort of has gone below the sort of 30 or the 20 threshold, whichever you prefer, then that's suggesting that something is now oversold, and sort of then you might be looking to buy it if other things line up as well. So I'd use the indicators on top of the any drawing tools and any charting that I do.
And what's the difference between indicators and strategies?
Well, the strategies are a combination of indicators. And so you might, and these can work very well for people. And I know a lot of traders who spend a lot of time and will swear by certain strategies. And certainly, there are systems out there where you can follow other traders and look at you can see whether a trader has been particularly successful with his strategies, and follow those and sort of see how they. And trade accordingly. But that's really all the strategy is. It's just a combination of indicators primarily, but and just putting those together.
And how do I know if I have a winning strategy if it doesn't win all the time?
Well, strategies work until they don't work. It's like anything. A market can be ranging until it breaks out and suddenly it's in an uptrend or a downtrend. So it's tricky. I mean, I guess you sort of got to play around with these things, see what works for you, and then but always bear in mind that something you're not going to get it right all the time. Even if you've got what seems like the most successful strategy in the world, it's going to go wrong from time to time. So you've got to sort of bear in mind always your money and risk management, whatever you're doing. That's not to invalidate your strategy just because it goes wrong once or twice. But it might mean you need to tweak it because markets change, and so do strategies. As I say, they evolve as well, and they're not. You might just say it's just. Is it really a matter of cause and effect? Was I just sort of lucky that particular strategy played out, but the market was moving not because of anything that was to do with my indicator? It was something completely else. You can't be sure of that. I mean, if we could be sure of that, then we could. Well, some of us could be very successful. Those guys out there who really know their indicators, who really work on their strategies, would be successful nearly 100% of the time.
And can you mention some tips on managing winning positions to maximise profits?
Yeah, I mean, I suppose it comes down to sort of if you've got an open, as I say, one of the best things to have is to get involved in a trend. When a market's trending, whether it be up or down, if you catch that, if you can identify sort of the beginnings of a trend, maybe because a market has broken out of a range, and the sort of like the pressure either up or down is sort of like pushing that particular thing one way or another, then you sort of really want to stay with that and run with that for as long as possible. And that in itself takes some discipline because, of course, when you're making money, it's quite a temptation to want to sort of cash that in. So what I would suggest doing then is sort of if you've got a market that's trending in a particular direction, you should already have a stop in place, but just keep on moving that stop up higher and higher. So you're locking in profits, and then if the market continues to move further and further, you continue to be able to lock in more and more profit. Eventually, the market will move against you and you'll get stopped out, but at least it would have been a profitable trade. So that's kind of one thing really. And I'd say sort of you're trying to, as I say, you're trying to aim to take emotion out of it. You're trying to get consistency in your trading. So you want a set of trading rules that work for you, and just try and stick with those. But then, bear in mind that if you're wrong, if you're consistently wrong, it's something you might need to go back and revisit and say, why is that? And talk to other traders perhaps and see, well, what are you doing? Or, that move in gold, did you catch that? I missed it, and or I got out too early or whatever. What did you do that I didn't? Blah, blah, blah. That kind of thing.